Well, hi there, and thanks for joining in for our Investment Review Committee Equity Growth Share Class update for March 2018. As always, this is Jason Ayers here, and I'm happy to have Alex Brandolini, our lead portfolio manager for the Equity Share Class Fund. Alex, how are you today?
I'm doing well, Jason. Thanks very much. How are you?
I'm doing well. So obviously, it's been a fairly volatile couple of months, and I know you've got some interesting observations you wanted to share. So why don't we jump right into the first slide?
Yeah, for sure. So volatility is back. We've talked about in the past how we've entered into a new volatility regime, and I thought it would be useful to provide some insight as to, what does volatility look like in the past? How long has it lasted? What did markets do during volatile periods? So I'm sharing a couple of things here. On the left-hand side, all I've done is I'm just showing everyone a graph of the VIX, which is the volatility index going back to 1990. And if you include intraday movements, it's been in about 10 instances since 1990 where the VIX has penetrated the 35 point on the graph. And every time the VIX has penetrated 35, the S&P 500 seems to have bottomed an average of 32 trading days after that spike. So trading days is just Monday to Friday, so 20 trading days would be roughly a month. The most recent surge we saw was on February 5th. Given how long volatility has lasted in the past, we further made the distinction between recessions and non-recessions. During non-recessions, which that would leave 7 data points, the S&P seems to have bottomed about 37 days, so a little bit longer after that. So what does that mean for the current environment? Well, we don't think we're in a recessionary environment, so that period of volatility could conceivably last maybe a week longer. Given what we know about volatility and what we know about the current environment, we actually thought it was a great time to use some option strategies, and that's what we did. And I'll get to that a little bit later when I talk about performance of the equity pool. But for as of today, we did see a low on the S&P 500. We're still within that 37-day period, so I think it's quite conceivable that we might see a retest of the lows. If something like that happens, we're going to use options on a second round. We've completed one round of option strategies. We may use a second round, but overall, we still think there are many reasons why we should continue to be investors versus we
Jump
should
into the
continue.
sidelines.
Yeah, jump into the sidelines. Thank you, Jason. So what are the reasons why we think it's still prudent to continue going long the market, whether it's through long stock or through option strategies and options exposure? So point number one, I just want to highlight that valuations on the S&P 500 have actually come back into line. They are no longer stretched. And that's kind of important to understand because PE expansion is not so much the norm for this point in the cycle. The point we're at is the mature phase of the cycle, and that's probably going to still last another couple of years. But PE expansion is not the norm. So the fact that we move back to normalized levels means that we've got an attractive entry point for new strategies, and we've definitely got some support. Now, for the market to move higher, what we're going to need is to see earnings performance. So, speaking to that, I've got a couple of graphs that are going to show earnings estimate revisions in both Canada and the United States. And the good news is we're looking at the S&P 500, so this represents the US. Your two top lines in the upper right-hand corner, 2018 and 2019, do show a recent spike in estimate revisions. So that's good news for the US. We see the same kind of thing in Canada. Earnings revisions have moved positive. They're above the zero line. So that means, both domestically and south of the border, estimate revisions are increasing. And I've spoken in the past few weeks about how sales estimates have been increasing. I didn't include the graph again, but I have talked about it in the past. And what's important about that is that you've got bottom line growth that is supported by the top line. So I would say these are quality estimate revisions. One thing I want to introduce that's new to the discussion is something called the Financial Conditions Index. So overall, getting back to the macroeconomic picture, we do think the macroeconomic environment continues to be supportive of stocks. And the reasons for that is that we've got low unemployment, we've got wage inflation that's returning, consumers are making more money and they're spending, that goes into consumer spending, and companies in the US are now able to save a lot more money on taxes, and a lot of that money is finding its way into a capex cycle. So given that macroeconomic environment, what do the overall financial conditions say? Well, we use something called the Goldman Sachs or the GS Financial Conditions Index. And that index is a composite of what interest rates are doing, what the exchange rate is doing, corporate spreads, equity markets. And if you look at the graph, the red line all the way to the right side on the bottom, we've got a recent uptick. But if you draw a horizontal line, what we're seeing is that financial conditions are still as accommodative as they were in 2014. So given this pro-growth environment, we think the economy can still continue expanding at a healthy pace. So overall, that's why we think being long the market is still a good idea. And given the volatility we have faced and probably will be facing in the future, because uncertainty is not done, when you consider new trade tariffs, elections, later this year, and uncertainty around interest rates, we still do think the heightened volatility gives us ample opportunity to use options for return enhancement and risk management. So that's my overview on markets and the economy and where we're at and what we think we should be doing. So given what we think we should be doing, let's take a look at what we have just done. So on a 1 month basis, the equity pool was pretty much flat. We had a positive 0.02%. That's pretty immaterial if you ask me. But the bigger story is that when you compare that to the index that we track, or that we benchmark ourselves against, that index lost 3.02%. So we did better than the index by about 3%. Year to date, on the left-hand side of your screen, we are actually up 1.4% as of the end of February, whereas our benchmark was down 4.37. So that's roughly 6% of alpha this year so far. I'm not saying that we're going to maintain that. Who knows what's going to happen? But I'm saying for the first couple of months during this volatile period, we've got some pretty good performance. It is positive and it's definitely outpacing the benchmark. Over the month of February, I would say some significant performance was driven by a rise in the US dollar. Some action we took around that is that we definitely lightened up on the currency. We did not change our exposure to the United States. That stayed pretty much where it was. But what we did is we removed the currency risk because we don't really think the US dollar is in a place where it's going to continue strengthening. In fact, we're seeing a little bit more weakness given the unsustainability of the rising US deficit. But over the month, we also did engage in a lot of profitable option strategies on higher volatility. So we sold some puts on the index at the height of volatility, which we later bought back. So we sold at a high price, we bought back at a low price. That's really the reverse of buy low, sell high. You make money either way. And we also sold some puts on some of our tech stocks, which offer higher implied volatility. So we were able to take advantage of that, both in terms of intrinsic value and in the contraction of volatility for net profit. So a couple of things we did over the month based on the environment. It worked out, and it definitely hit the bottom line for the pool.
Very good. Excellent. Well, as always, thank you so much for your time today, Alex, and thanks everybody for joining in.